Hello and welcome. In this video, I'm going to explain to you guys what real and main order blocks are. Not every order block is a real order block. The main order blocks are the ones which are backed up with both smart money and liquidity. An order block must meet 4 basic conditions in order to be considered supported by smart money and liquidity. Later in the video, I'm going to teach you guys some methods for identifying the main order blocks and how to make profit in your future trades using these methods. This strategy of identifying order blocks is completely exclusive and nobody knows about it. I'm going to reveal this strategy for the first time ever. Make sure to pay your full attention to this video. Now let's get into the explanations. What is an order block? What's the definition of an order block? The highest candlestick in the direction of the momentum and opposite to the reversal is called order block. In other words, order block is the last push of candlesticks in the direction of the momentum and opposite to the reversal, which is this candlestick here in this position. This candlestick is our order block. In this different position, this candlestick is our order block. The last push of the candlesticks in the direction of the momentum and opposite to the reversal. Okay, why do we try to find order blocks? We use order blocks to distinguish the trade targets of the central banks. Like here we could catch the last target of the central banks. The reversal orders of the market are also piled up in these areas. Like in this example, the orders are collected in here and then the price started to fall. And here is an example in an ascending trend. The last push of candlesticks in the direction of the momentum and opposite to the reversal. Only the first and last order blocks in a momentum are the valid ones. Here is the first order block in this position, and here is the last order block. These two order blocks, which are the first and last order blocks in this situation, these are the only ones we can consider valid. Now, how do we detect a first order block? Take a look at this order block. Whenever the order block is formed, if the last peak shows a break of a structure, the order block is valid. Like here, this order block is valid because this swing high shows a BOS and it has collected the remaining orders from down here, from the order block which is our demand zone. And after that, the price has gone up. So we consider an order block valid when it breaks the previous momentum. Here, this is the last momentum previous to our order block. Here, by formation of this order block, the last momentum has been broken. Here, this previous roof has been broken, and after collecting the orders, it continues its momentum again. So this order block has got high validity. But when are the order blocks not valid anymore? For example, here was a last order block. The price has reacted to it once and decreased. If this last order block is broken even once, it loses its validity and we wouldn't consider it a valid order block. And because here the order block has been broken once and following that the market has collected the remaining orders, afterwards the price has moved upwards and has passed the order block easily and it's kept on moving upwards. So this order block is not valid anymore. But here is the real last order block. Here the price has increased and it's formed a BOS. And then it has fallen and collected the remaining orders and afterwards again, the market maker has made the price go up. If the price falls and breaks this order block loses its validity. If this happens, the price will probably have a pullback to the order block and then continue to fall. But if it doesn't break the order block and it bounces back up, it would reveal that there are still buy orders left in here and the market has collected some buy orders here and it has gone up again. If this happens, it shows that the order block is still valid. If the price breaks this order block downwards, this here will become our first descending order block. This candlestick will turn into our first descending order block. The lesser candlesticks an order block contains, the more validity it has. Like this order block that is made of only a single candlestick. The order blocks which contain only one candlestick obviously have the most potential in validity. Okay, so we got an order block over here. We can see a BOS formation as well. Here is another order block which has also made a BOS of the peak. Now let's see which of these two are valid. Is it this one or this other one? Let's keep watching. You may ask, why didn't the price reach this order block down here? Why did the price bounce back up from the middle of these two order blocks? And how could we know which of these two order blocks are valid? Whenever after an order block the price spikes and goes up sharply, we get the second confirmation for an order block's validity. But the price down here hasn't gone up quite as sharp as this other one up here. The power of this order block down here is lesser than the other ones. So it is obvious that there are more buy orders up here than the area below. Now let's answer the question, why didn't the price reach this order block down here and it bounced back up? This is a secret not many people know about. This area here is the liquidity area of the market. The price drops down to this point and the market collects the liquidity and then it goes back up again. Before reaching this order block here, the price starts its movement upwards again. Wherever in the market, if there is liquidity area, after collecting liquidity, the price increases sharply because there aren't any orders left here and the market has collected all liquidity. This is the area that retail traders set their stop loss to. For example, they enter a trade here while considering this order block and they put their stop losses in this area here. The market maker collects liquidity here and doesn't leave any orders remaining. It also has already collected its own order block here. So after this point, the price goes up sharply. This liquidity area between two order blocks is very important. When two order blocks are really close to each other, they form a liquidity area. But the distance between them shouldn't be greater than 100 pip. In this example, the distance between the two order blocks is around 50 pip. And 50 pip is lesser than 100 pips, so this area can be considered a liquidity area. So this is the reason there is a fake breakout here, and after that the market has collected the liquidity and the price has gone up. Otherwise, this order block up here is more valid than the other one. Let's see how the price reacts to this order block. I mark the order blocks with two lines. Okay, here the price has touched this order block. Now let's check out its reaction. Here again, the market maker has collected its remaining orders and the candlesticks has gone up with a high ATR. We enter a trade here and set our stop loss under this area. See here, the price went up sharply and gave us profit with risk-rewards ratio of 2. Let's check out further price reactions. The price reached this area again. We should wait here till the candlesticks move up from this area again. Here again, the market maker collected the order and the price went up again. Therefore, any order block that has a spike following it is more valid. This order block is the same one back here. This single candlestick order block, which the price has reacted to it. 1, 2, 3, 4 times. Here the order has been collected again, so we open a buy position too. Like here, we set the stop loss below this area. Let's wait for the results. The price skyrocketed again and gave us profit with risk-reward ratio of 3. Let's see the rest as well. The price reached the order block yet again. Again, the orders are collected and the price went up with an ATR bullish candlestick. We open a trading position here. We put the stop loss below the swing low and we wait for the results. Again, the price went up. The price broke through this roof with a lot of power. It probably was the last of market makers' orders here that the price broke this roof, and it is most likely that the price goes even further up. Here, a descending order block is formed because it could break this floor and make a BOS. Here, another descending order block is created, so this area between two order blocks is the liquidity area. The main and valid order blocks have 4 conditions. The first condition is that they break the main supply-demand zones. Here is an order block and a demand zone which this other order block has broken at and made a BOS. This order block is valid because of the BOS and breakout of the previous order block downwards. The second condition is that it should contain fewer candlesticks. The best is that it has only a single candlestick. See here, the order block has a single candlestick, and when an order block contains only one candlestick, it has more validity. The third condition is the formation of a spike after the order block. Here, we got a spike that has broken the previous demand zone. This supply order block has got all 3 conditions and it's looking pretty valid so far. Now, the fourth condition is that it shouldn't have a big correction afterwards. Like here, the price has fallen till this order block and it doesn't have any great correction, which it shouldn't, in order to have validity. If there is a correction, it must be small, like this big. And that was the 4 conditions of main and valid order blocks. This single candlestick order block has got all the conditions, so this is a main order block and it is very valid. Price has reacted to this order block here, and because it has got all 4 conditions, I enter a sell trade in this position and set my target here. Let's see the rest of the movement and the results. So the price went up and bounced back down from this order block up here. Remember, this area here was the liquidity area. The market maker has collected the liquidity here, then the price has gone down afterwards. But this order block down here is way more valid than the other one. This is the original order block. Here, the price has only went up and it has hit the stop loss of retail traders to collect the liquidity and move down again. Let's see the rest of it. The price reached this order block again, and with the formation of a pin bar candlestick pattern, a sell signal has been given to us. Because the price has already went up here and the liquidity has been collected once, I set my stop loss to this point with no worries. Let's see the results. See how far the price fell, and it formed a BOS here with a powerful candlestick. The last remaining orders here has been collected by the market maker. That's why we get a sharp BOS here. The market maker has collected the liquidity here and then it's collected their own orders afterwards and then price has fallen sharply. So this is a main order block which has all four conditions. This order block back here. Let's do some backtesting with this strategy of using order blocks. I'll use the calculator to find out how much profit we made in these few trades. In only 8 trading positions, we made 1,729 pips of profit. If you follow my instructions, you can also find the order blocks on the chart and do backtesting for the purpose practice. These order blocks that you see here are all valid, and the market has reacted to them all. These 4 conditions of order blocks are very important, but nobody had ever mentioned them. This video contained a lot of important and useful points. I hope you enjoyed it, and in the next video I'm gonna reveal a new RSI strategy. This RSI strategy has never been taught anywhere, and it is completely exclusive. So make sure to subscribe and turn on the bell to get notified when the next video gets out. Hope you're all successful and profit making. Take care and goodbye.